Welcome to the Highway 1 Capital Market Outlook Zoom meeting. Thank you all for your attendance. Just as a quick note, this Zoom is going to be recorded for compliance purposes and also with the goal of posting it to our website for those that aren't able to join real time. So hope you're all having a great day and lots to cover. We'll try to make it brief, but give you a lot of really good substance. A lot going on in the world right now. But before we start, I just want to give a big thank you to all the families and individuals that we work with. You guys have been incredibly supportive. We appreciate your confidence in Highway 1 Capital, and we're honored to be part of your team. So we always want to start with thanking you because you give us a big reason to work hard and continue to track what's going on around the world and have good investment themes and deliver good returns for you. A quick update on the growth of Highway 1. You all know me, you know Tim, you know the uber talented Taylor Ford. Taylor's been awesome. Some of you have spoken with Kelsey Unger. Kelsey's a good part of the team. She supports Taylor in all the client service efforts to make sure that all of you are getting the service that you deserve. So Kelsey, thank you so much for all your hard work. Leon and Evan, they're working behind the scenes. There are two CFOs. They focus on the business side of Highway 1 Capital. So Tim and I could spend our time managing your portfolios. Also, Elizabeth Barrett, she does a great job for us. She's on our website. Elizabeth handles really all of our client communications. Most of the content that you see on the website, she's really integral in keeping that relevant and timely as well. So thank you, Elizabeth. And a special note, we are incredibly honored to share some news with you. Liz Warden, who some of you know from the First Republic days, Liz was a big part of our a big asset to our clients at First Republic. She's an incredibly talented lender and banking specialist. She's a relationship manager. A lot of you have met her, and she's helped you with your lending needs over the years. She obviously, like us, went to JP Morgan after they took over First Republic, and Liz joined our team last month. She's part of Highway 1 Capital and going to be a great resource for all of you, the lending and the banking side. So Liz is incredible. She helped us out so much over the years, and we're really, really thrilled to have her on board. So Liz, welcome. And on behalf of Tim and Taylor and the rest of the team, we are thrilled to have you.
Thank you very much. Happy to be here. Sorry, my video is not working today. But it'll be working the next time. So
yeah, her
excited.
Her picture just got on the website, so you could check out her bio. But one thing of note is you see this amazing, sweet person, Liz. What most don't know about her is she's a race car driver, and you don't want to be anywhere near her on the racetrack. And she'll cut you off if you're close to the finish line. She's tough as nails, but she does a great job. And thanks, Liz. So. Let's move on to the economic landscape. Obviously, there's so much in the news right now. There's been so much volatility in the portfolios. And a lot of you are asking very fairly, like, what in the world happened, right? Coming off of the election in November, regardless of your political affiliation and who you voted for, there was a lot of optimism in the markets on, a pro-growth, pro-business agenda that was being put forward. And really, since the start of the year, the last couple of months, things have really changed. And we've seen asset prices going down. We've seen yields falling pretty sharply, slowing growth. Rising inflation, dollar weakening, gold going up. There's been a lot of changes in a pretty short period of time, and I know Tim will cover some of that as well. But really, in our view, when Tim and I look at it, there have been three major things that really have happened that have kind of changed the landscape that we need to make sure that we're comfortable with what's going on and how we're investing your money now and going forward. But the three major areas that changed were U.S. politics, the U.S. economy, and then artificial intelligence. And they're all super important to make sure we get our arms around. Looking at the politics, that we're not going to talk about who, we don't want to get into a political discussion, but we do want to talk about the policy that's being enacted and how that could impact our portfolios. So, this is Trump 2.0, right? There's quite a stark contrast between Trump the first time as president and then Trump right now. And I think the general assumption when he got elected in November was that, in typical Trump fashion, he's big on the talk, right? And then, his action was going to be a little bit muted, maybe, for negotiating tactics, talking pretty significant tariffs, and maybe the end result's going to be something, maybe a little bit more palatable for, for the markets in terms of inflation and whatnot. But clearly we'll know more tomorrow. I mean, I think the media is getting really ahead of itself in terms of these major forecasts. I mean, we still don't know how things are going to play out, but tomorrow he's going to, share with us a little bit more thoughts about what he's doing on the tariff side. But, clearly there are going to be changes, with trade deals, not only in North America, but also around the world as well. So we should have more for you. And it's literally changing on a daily basis. We were on a call this morning with one of our good contacts at PIMCO, and they're like, they've lowered some of their forecasts, but a lot of it was, hey, this could change every day, right? As the news comes out and as we're getting a little more clarity on policy, but things could change pretty quickly. You look at what's happening with Doge and uncovering some of the fraud and some of the federal employee layoffs. And we do know that Trump 2.0 is much more serious than he was at 1.0 and making dramatic changes. So a lot to cover there, as not only today, but as we go forward. The U.S. economy, that's clearly where Tim and I spend most of our time in terms of formulating our opinion. The U.S. economy is still strong, and Tim will talk more about that as well in terms of what we're doing. But the economy is softening. No one can argue that. It's clearly softening. Interest rates have been falling. The 10-year, what, Tim? It was 4.12 earlier this morning.
4.12. I think we closed somewhere on 4.15 on the 4.15 on the 10-year.
Yeah, so that actually has some positives to the economy as well. But clearly, we track interest rates closely. One of the things that's going on with the economy is the consumer sentiment is changing, rapidly. It's deteriorating, whether it's the University of Michigan study or the CFO survey or the CNN fear greed, index. It's extremely bearish. So, the sentiment has turned bearish dramatically, and that actually could be, maybe a good sign about things going forward. But we can talk about that in a little bit. But clearly, the U.S. economy is slowing. There's no question about it. And the third major change that happened, and it kind of happened overnight for most of us. I mean, with DeepSeek, is there was some pretty significant developments with artificial intelligence and some of the competition to the U.S. companies. And with DeepSeek, you look at that questions whether the $50 billion of capital expenditures from the big U.S. tech companies, whether that's viable and whether that's prudent going forward. If their competitors could spend less in capex and get the same productivity, then that questions some of the multiples. So we saw a pretty big shock earlier with the news on the artificial intelligence side. But AI is a theme that Tim and I believe in going forward a lot. I mean, it's not going away. But we do have to monitor some of the developments in technology. So those three things are really critical to get right. The U.S. politics, and that's moving daily. The U.S. economy, a lot of shifting there, and then what's happening with artificial intelligence. So basically, the uncertainty is causing asset prices to come under pressure, and then also what we're seeing is any station that you turn on for news media, I mean, it's turned pessimistic, and it's created a lot of emotion, a lot of selling. I mean, a tremendous amount of selling out of assets, and we've seen what we've seen yesterday and today in the markets, pretty significant sell-offs, and then the markets rallied back. At some point we're going to be catching, maybe a bottom at some point, at least a near-term bottom, and probably some opportunities for, for some decent returns. But Tim, you want to share some thoughts on, kind of on what we're doing?
Yes, thank you. I appreciate that. And I appreciate everybody. Our clients have showed us so much support, and I echo what Dustin said. We value each and every one of you, and just really appreciate all the support and patience. Look, the street is confused. Institutions and analysts are split on where the direction, what direction, the market's going. The fourth quarter GDP was 2.3%. The first quarter of 2025, the consensus is 0.3%. Has to do with several factors. There was an inventory build going into in the first quarter, which because of the tariffs, which is a drag on GDP. Consensus growth for this year, we expect the second quarter at 1.4, the third quarter at 1.6, and the fourth quarter at 2.0. That's pretty good. That's pretty good growth. We got through the first quarter. The markets are volatile, but there's a lot of pain out there in the expensive stocks. But optimistic for going forward. Inflation is right around 2.9%. We don't, the street doesn't expect much movement there. That could make it tough for interest rate cuts. The high side of the cuts are three cuts expected on the high side. On the low side, it's 0.
Yeah.
So that's where the street is just so split. We got unemployment rate at 4.1%, probably going to be pretty close to that all year. And something that we're really bullish on and we're really pleased with is that, and Dustin's mentioned it a couple times, interest rates have come down. The yield curve is somewhat normalized. It's still inverted from 0 after 2 years, but from there it starts to normalize. Not great, but it is normalizing. So that's the data. We think we can make money in that environment. We have some really great ideas. We think for the second half of for the second quarter and second half of the year. Hard to believe we're already through the first quarter, but here we are, and we expect to do well for the year.
Yeah, thanks, Tim. I really appreciate that, letting everyone know, kind of what we're doing. That they turn on the TV and they see, some of the news, and it's like, I mean, it looks pretty bad, but the economy is still strong. I mean, whether it's 1% or 2% based on the forecast, or positive earnings growth. One of the things you hear a lot about, and just to put it in perspective, is stagflation. We're hearing that's the new word, stagflation. We've talked about it a lot over the years. It's not a pretty scenario if that develops. And there are some trends that we have to watch that are that could create a scenario of stagflation. But let's keep in mind, I mean, if you look at the Federal Reserve right now, they're in a really difficult position, right? They really have this dual mandate, right? They have to look at slowing growth, but also rising inflation. That's kind of what the deal with stagflation is, right? You have deteriorating economy, rapid inflation, and unemployment falling apart, right? Or rising unemployment. But the challenge the Fed has is the economy's slowing. So what does the Fed do when the economy slows, right? They ease, they cut rates. But what does that do to inflation? It typically causes inflationary pressure. So that's that, it solves growth, but it causes the inflation side to become difficult. How do they fight inflation? Right? They raise rates, right? Try to slow things down. The problem is that slows growth even further. So they're in a really tough spot. But keep in mind when you hear people talk about stagflation and how terrible it is, and it's not an easy one to navigate through. But they point to the 70s and the 80s. The inflation right now from the Fed, and this is an important one to remember, the Fed staff is now projecting CPI to be at 2.8. They originally had 2.5, and so they've increased it from 2.5 to 2.8. 2.8 inflation, yes, the trend is going higher. But in 1980, CPI was 13.5%. So let's keep things into perspective. Clearly, if we go into a recession, we have prolonged slowdown in the economy. If unemployment raises, becomes a problem, and inflation, continues to go up, it changes how we need to allocate your capital in terms of still creating returns and also mitigating risk. So we're watching it closely. If you have more questions on, stagflation or anything else that you're concerned about, call Tim, call me. We'll be more than happy to give you a deeper dive and also how it's impacting your portfolio. But it's a challenging time right now, no doubt. The Fed has their hands full, but they've navigated pretty nicely through some tough times. So we're going to get through it. Thank you all so much for your time. Thanks for joining this call. And if you have any individual questions, feel free to give us a call, shoot us an email, set up a time, or just give us a call. Okay. Thanks, everybody.
Thank you.